So next up on stage is Chris Skinner from The Financer. I'll also go through his resume. It's also pretty impressive. So it's long, so I have to read it for sure. Independent commentator for financial markets and fintech. He's the author, in addition to authoring The Financer, which is one of the most popular fintech blogs out there. He's also author of best-selling books, Digital Bank and The Value Web. He's also the chair of the European Networking Forum for the Financial Services Club, as well as the Nordic Finance Institution. And he's been voted one of the most influential people in financial tech by both the Wall Street Journal and Bank Info Security. In addition, he's been featured regularly on BBC, Sky News, CNBC, and Bloomberg, mostly speaking about financial tech and fintech. Thank you, Chris.
Thank you, Rob. Hopefully we'll bring my slides up. And thanks for coming and for tolerating a strange accent. It's interesting that I've been blogging every single day for 10 years, every single day. And the reason why I do that is that the world is changing rapidly. Can you bring my slides up, please? Just click. Okay. There we go. So, I was intrigued listening to Nathan because I think the CFO of the future is an algorithm. Deployed the late guy. And, so is the COO, to be honest. Why do we need these guys? Let's just do everything through software, which being here makes absolute sense because that's the way we work. And I'm going to talk a little bit about the open sourcing of finance and how, to be honest, having spent many years dealing with proprietary bank structures and technology structures, we're moving to a world that's plug and play, which kind of makes sense being here. And if you want to know what I mean by plug and play and open sourced, I blog about it every day. I'm producing a new book. I've actually had several books already out there, Value Web, Digital Bank, Banking in a Globalized World. I'm not going to labour the point, but I'll read them. And Digital Bank is actually where I started to get known over here because in 2014 when that came out, my main focal point was that banks are becoming redundant. It's not working.
Yeah. You guys having trouble hearing me?
You're projecting very well.
Okay.
Yeah. Just fine.
They need that for the camera, you see. So now I'm more than vocal. I shall stop projecting and just talk. I'm so British, I'm getting boring myself. Anyway. So Digital Bank was all about how banks are becoming redundant if they don't digitalize their structures. And what I mean by that is that banks were built in the Industrial Revolution for the physical distribution of paper. And that physical distribution of paper is focused on a localized network of buildings and humans. And that's been the way it's been for 300 years. And now we're going, geez, what I want to do is have everything real-time transacting through the Internet of Things and billions of things transacting in real-time, non-stop, globally, 24/7 through the Swift counterparty network. I don't think so. It just doesn't make sense to do things like we did anymore. We need real-time, we need immediate, we need global, we need connectivity for everyone. I mean, in the internet of today, what amazes me, because I travel non-stop, is I can be on the top of Mount Everest and make a payment. I can be in the middle of Rwanda in Kigali, or actually make it even better, in the Volcanoes Park, where the mountain gorillas are, Dian Fossey, gorillas in the mist, and I can make a payment, I can transact and trade. That's the way it is today. I don't want to have this old network of physical distribution of paper. I want digital distribution of data. And so we have to reinvent the financial system. And we are. And a lot of that's taking place here, although a lot of it's also taking place in China, in Africa, in Asia, in other parts of the world. So I'm going to talk about that. And in particular, the model that's changing, which is a model of a business that historically has been focused upon the product. And in a lot of banks, by way of example, in Rwanda, when I was there at the conference, M-Pesa, which is a business that's based around mobile money, well, I asked them, how do banks compete with you? They said, well, they copy our product. They imitate our interest rates. And they don't focus on the customer. And if you look at the business model of any business, it starts with manufacturing products and services in the back office, but then it links through processing and infrastructure in the middle office to giving a great customer experience in the front office. And that is the basic outline of any company, including banks, but including Apple, Google, Microsoft, you name any company. This is a basic business model. And in fact, it was written about in depth in a book in the 1990s that I used to use regularly for consulting purposes, The Disciplines of Market Leaders by Michael Tricky and Fred Rosema. If you don't know this book, the premise of the book is that most businesses are three companies in one: a manufacturer, a processor, and a retailer. And most companies are good at one of these things, but they're pretty awful at the other two. Some are good at two, some are good at three. Very few are good at all three. Most are good at one. And most banks, to be honest, if I look at this chart, their exceptional prowess is in the middle office infrastructure. Never drop a payment, do everything immediately. Some of them are good at products, but most of the product stuff is commodities, interest rate churns. Most of the front office, do they care about the customer? Not really. All banks are the same. So then I look at that and I go, at another layer, another big book in my learning of how to deal with business was Re-engineering Incorporation by Michael Hammer and James Champy, which for those old enough in the room will remember business process re-engineering. And I was particularly trying to promote business transformation. But every bank I dealt with wanted incremental improvement, because incremental improvement is easy. Transformation is really difficult. Now, the premise of business process re-engineering is that the back office is products, and the middle office is processing, and the front office is people. Really simple. Products, process, and people. And if you're really good in the front office, engaging your staff with customers, then you'll have a winning business. I dealt with a great insurance company in the 1990s who had this view that happy people make happy customers, makes happy business. I still believe that's true. If your people are happy, they give that culture across to their customers. And the culture is the people. That is the culture. So now we've moved to today's world, and actually we've moved and replaced the process and the people with platform and experiences. And so today we live in a world of platforms and marketplaces, and how we engage our product to our customer through those experiences through our platforms. So platform, as you'll all know, because I think Uber's mentioned here, if I need a ride, you'll connect me through the platform with a driver, and that is the company that does that, along with Lyft. And an interesting discussion around which one's better. If I need a room, because I'm traveling, then you'll connect me with someone who has a room through a platform. This is the democratization of everything. This is the change we're going through with everything. If I need entertainment, it's slightly different, because the entertainment firms are competing on content. So that's the reason why Amazon and Netflix are spending so much on the product, because you have to get the customer on your platform, and you'll only get that if you have good product. So it's slightly different in the entertainment industry. But what we see is this platformification, democratization, changing the game, because the industrial era companies who did all the heavy lifting are becoming redundant. They're becoming an overhead. They're becoming ridiculous, to be honest. They have all these people producing hardly any value, when we have all these guys with technology and platforms replacing the need for them. Do I really need to buy a car when I can share one? Do I really need to own a home when I can share a room? In the sharing economy and a platform marketplace structure, do I really need these old world ideas which no longer are relevant or work? In financial services, that's what's happening. And that's why it's relevant for you guys, because if I have a need to buy a car, for example, then I can get the money from anybody who has money through a platform. The first fintech company I ever met was Zopa, which is a UK peer-to-peer lending company. And they presented at my club that I run in London in March 2005 and talked about the fact they were launching a platform that was an eBay for money, to connect those who need money with those who have money. Everyone thought they were stupid. 4% of the UK personal credit market today, doubling year on year. So 8% next year, ooh, that's a lot. Platforms are the way to go. And it's the reason why we're seeing the whole of everything to do with financing becoming democratized and put into a marketplace platform, because it can. You know, technology eats the world, software eats the world. We're changing everything and saying any part of what financial services used to do can be done through an algorithm. Just as a CFO or COO can be an algorithm. Just as Tripaldi are providing algorithms and APIs and capabilities to do your accounts payable. Anything can be eaten by software. We know that. We accept that. We believe that more here than anywhere else. And I view it as the apps, APIs, and analytics of the front, middle, back office. This is the big change that really changes everything in financial services, because when we know that everything is apps, APIs, and analytics, then we can start to look at the next decade and say the Internet of Things will have an Internet of Value that's provided through apps allowing trading and transacting through machines, fridges, cars, homes, clothing, anything. And those things will be connected through APIs in a marketplace of a smorgasbord of a menu of choices, where companies that specialize in very narrow focus, doing one thing really well, outperform those old proprietary structures incredibly, because the old proprietary infrastructures do a lot of things very badly. These guys do one thing well. And then the analytics in machine learning and artificial intelligence in the cloud is where the competitive battlefield will be, knowing me better than I know myself. You know, the semantic bank, the idea of a semantic financial advisor, someone who knows me better than myself, like the semantic web, connecting everything and knowing my digital me better than I know me. That's where we're going. It's happening. It's not something of the future, it's right now. And this is the marketplace of the fintech startup community. You know, when you look at how many companies have launched in the last decade, with $100 billion of investment in the last 4 years, that $100 billion isn't being thrown away. It's being invested in reimagining the way we do money. And this is transformational, this is dramatic, this is revolutionary. Because when we look at these components that we can integrate and aggregate to give great customer experiences in the front office, linking the APIs in the middle office to the back office, then we start to get into a different way of thinking, which is difficult for the incumbent institutions. Because the incumbent institutions are used to controlling everything. I was just on a trip in Norway and Sweden last week with a group of friends called marketplace banks. Of which there aren't many, but there's a growing number. One example is Saxo Bank. This is a Danish bank that was launched in 1992 for capital markets, trading and investing. And what they now offer their partners is a smorgasbord of APIs for trading and investing, such that you can link to every exchange in the world through their API. Yeah, it's impressive. You just plug it in, and suddenly you can trade and invest anywhere in the world in real time, 24/7. Solaris Bank's a new German bank created by some guys who used to work for Deutsche Bank. And their focus originally was going to be on being the fintech bank for fintech banks, for fintech companies. You know, a fintech company starting up doesn't quite have the ability to do clearing. Well, plug in the API from Solaris Bank, you can now do clearing. And suddenly they found that they're actually very popular, not with fintech companies, but with merchants online. Bud is a new startup from London that's focusing on consumers and giving great consumer experiences through APIs, understanding my digital footprint, that you can plug into any retail bank. And suddenly they're finding the big four banks in Britain are getting very interested in what they're doing, as are the big four banks in Clearbank, a brand new clearing bank that's been launched in Britain in February, are the first new clearing bank in 250 years, based in the cloud. Just an API plugin, and suddenly you can clear through all of our high and low volume payment systems. If you don't want to use them, you can go through the big four banks, HSBC, RBS, Barclays, Lloyds, take you weeks, cost you a load. You can do this in a few minutes, just an API. In fact, the biggest bank that's been launched in the last few years is Ant Financial from Alibaba. And I often think that when I look at what's happening in China, it's more incredible than anything I've seen. I got voted off stage here 10 years ago, it shows my age, for saying that China was going to decimate the American banking system. Not a popular thing to say in America. But the Chinese banks have grown to be really heavyweight institutions. But actually, it's not the Chinese banks that are the heavyweights, it's the Chinese internet giants. And Ant Financial recently offered a marketplace of apps, APIs, and analytics. And I wrote a blog about it saying that they're being used by over 40 Chinese banks, including some of the biggest like China Construction Bank. And an Asian banker actually contacted me and said, "You're talking complete rubbish, Chris." I said to use stronger language, because there's no way that such an upstart can be so big so soon. Wrong. They've done it. You know, they're there. Ant Financial, when they spun off from Alibaba, are worth $60 billion. That's 2 Barclays banks, 3 Deutsche Banks, a brand new fintech startup. And where I think banks have to change their mindset is that instead of being controlling front, middle, back office and developing everything, they have to become curators of these marketplaces of apps, APIs, and analytics to serve you. Or equally, you could be your own curator of apps, APIs, and analytics and serve yourself. You don't even need a bank. You know, at the end of my tour last week with Bud Leveris and the guys I've just mentioned, I realized I can put together Saxo and Solaris and launch my own bank. I don't need a bank license, I just plug them all in and create a great user experience. I don't need a bank. We need banking, we don't need banks. That's the nature of the game today. And the banks have to reinvent themselves and become curators, because maybe I don't want to curate all those different apps, APIs, and analytics myself. Maybe I want someone who I trust to do that for me. And this is what we do with car manufacturers. Car manufacturers in the 50s distributed and serviced the product. They built and manufactured the product. They built not just the product, but every component inside the vehicle. They don't do that now. They just curate lots of components, sourced globally from different providers, into different form factors that we then get delivered and serviced by whoever we want. We don't have to get them delivered and serviced by the manufacturer. This is what's happening with banking. Anybody can curate and create something that's of value to us, including ourselves. Or we can leave it and delegate it to our financial providers to do it, because we trust them thanks to their centuries of history. The whole open sourcing of financial services through apps, APIs, and analytics. That's the reason why Fintech is getting so much investment. $100 billion in the last 4 years. You see this drop off last year, it's because, I would say, either it's because the venture capital community became mature and wanted to see whether their investment was going to pay off, or it's because of Donald Trump and Brexit. You can make your own mind up. But the fintech world is in a wave that's actually a lot more granular than fintech. It's got insurance tech, it's got wealth tech, reg tech, it's got artificial intelligence, machine learning, it's got robotics, it's got this whole idea of mobile wallets. Different things are happening at different levels. But what is happening overall is the open sourcing of finance so that we can do accounts and accounts payable ourselves through an algorithm and an API. It's a dramatically different world. And it actually impacts amazingly on companies. By way of example, Ant Financial was started in 2004. So I say 2015 because that's when they were spun off from Alibaba and rebranded. But when you look at Ant Financial, for example, it's a company that's generating millions in value per employee on a level and scale far beyond JP Morgan Chase, who we think is the most valuable company in financial services. And this is because we're going from the industrial era to the digital era. And companies that specialize, like the PayPals and Ants of this world, are worth more than their predecessors by multiples and factors of thousands. Bearing in mind their employee base is a tenth or a hundredth of the predecessors. This is a revolution, and this is what I think we have to start to get to grips with, because I don't think we have. In fact, what amuses me from my side is that I talk to a lot of European and American banks and companies, and they worry about GAFA. You know, Google, Apple, Facebook, Amazon getting into banking. Oh, that's going to be terrible. They'll take all our business. What will we do? I don't worry about them at all. I worry about Fatbag. Facebook, Amazon, Tencent, Baidu, Ant, Google. Because the Chinese giants are the ones that I actually watch really closely. They're very different in behavior to the American giants. Because one of the big differences is that if you look at Tencent, Baidu, and Ant, Alibaba, they do social, commercial, financial in one closed-loop ecosystem, which when you apply artificial intelligence to that closed-loop ecosystem means that they can understand my social, commercial, financial life intimately. And that's exactly what their strategy is. Understand my social, commercial, financial life intimately and leverage it to the hilt based on my digital ecosystem movements using artificial intelligence. Ant Financial's made a statement at the World Economic Forum at the start of this year that they will have 2 billion users by 2025. Well, that's not going to be in China because there's only 1 billion or so people in China. Oh, maybe they're going to go global. Oh, wow. No wonder they want to buy MoneyGram over here. Because that's the strategy. Get my social, financial, commercial life. Grab it, keep it, understand it, be intimate with it, leverage it. Whereas here, you know, PayPal, Facebook, Amazon are separated. Imagine if they were integrated. That's what the Chinese internet giants are. Imagine Facebook, Amazon, PayPal merging tomorrow. I hate to say it, but we're in a legacy economy. Same in Europe. Yeah, we have infrastructure implemented before Mark Zuckerberg was born. And we're trying to renovate it and upgrade it and keep it up. China's just leapfrogged all that. You know, $5.5 trillion worth of mobile payments last year compared to our paltry 112 billion. This is where we need to think about the new world order and the new way of doing things, because these guys are setting the standards and are going global, along with other economies, which I call the innovation economies of Africa. So I'll just finish by saying, you know, we are living in an open-sourced world of finance. We haven't quite understood what that means yet, and a lot of the incumbent institutions are remaining in a proprietary view. And a great way to illustrate this is I was in our Norwegian group in February, and Nordea, a very well-known old Nordic bank, announced their partnership with Spiff, a fintech startup. And the CEO of Spiff stood up, and his first words were, "My 3-year-old son likes to play with dinosaurs. So do we." Hugely respectful of his new partner. Not. And I kind of thought about it, and I thought, you know what, when I deal with a lot of banks, which I do, particularly European American banks, I walk into the boardroom and I'm met with a bunch of old white men. You know, it's kind of like, where's the diversity? I mean, where is the leadership? Where is the understanding of technology? Where is the vision of the next generation of the world? Where are the people who are going to change the bank? And my problem with this is that in thinking about it, and I picked up a report actually from one of the big consulting companies who analyzed every annual report of the big European and American banks. And they found that 6% of the C-suite team have had some technology experience. That's terrible. That means that 94% have no idea what the hell I'm talking about when I say distributed ledger and blockchain. What's the difference? They would have no idea. You know, what's the difference between machine learning and artificial intelligence? They wouldn't know because they have no idea what I'm talking about. How can they change a bank to be a digital bank if they have no idea what digital means? This is the problem. This is the fundamental issue in the institutions that we're talking about as the large financial incumbent institutions. They have no idea what Silicon Valley is talking about, which for a fintech is a bit of an indictment because banks are fintechs. They need diversity. They need to have people who have technology knowledge in their boardroom. This is from Reuters the other day, and it just made me laugh because you may not be able to read it, but 43% of the large American banks' core systems are built on COBOL. I used to program in COBOL. And you're shaking your head, sir. I think you used to program. You used to program. Oh, there's a few guys left. You can make a lot of money out of this. I'm serious. Because the banks are calling guys off the golf courses who are retired and saying, come back, we'll give you $300,000 a year to program in COBOL. They can only do it for so long, because unfortunately some of these guys are dying. Luckily you're still here. You know, we can't live with these old antiquated systems because like they just don't survive. We've got to renovate, we've got to refresh, we've got to reimagine, we've got to rethink, we've got to open source, we've got to collaborate, we've got to co-create. We've got to be part of a marketplace, creating platforms that engage everybody. And for the incumbents, their biggest problem is, can they ever commit to doing that? I seriously question whether they can. Thank you.
Any questions before Chris departs?
So this might be slightly muddied of a question, but part of the vision that you describe, very much underway, could be confounded by some of the legislation recently in net neutrality, because it really requires open access and that freedom of unbiased data transfer. And then fundamentally, you've got blockers like that along the way, but what you've described as the movement of wealth and money, but fundamentally as our economic system is industrial age, when we look at post-capitalism, does this paradigm that you describe really exist only founded in an industrial era economy, or how is it going to enable that transition to post-capitalism?
Yeah, I mean, I'm writing a lot about different facets of the world, and what I see happening is a three-stream economy around the world, which is the legacy structures of Europe and America, who are trying to basically evolve what was there to keep up with what's going forward. And I think that we have that wrong. And the reason that we have it wrong is by way of example, whenever anyone says to me channel or omni-channel, I almost regurgitate. And the reason being is that to me it's like saying, I'm going to tape that. You record things, you don't tape things anymore. Tape is last century. Channel is last century. And the reason why we use channel is purely because we sticker things on top of our old infrastructure for so many years now that we've got used to saying we can sticker this on top of old infrastructure like lipstick on a pig. But finally, you've got to realize that pig is pretty ugly underneath, and renovate, reimagine, and redeploy. So what's happening in China and India and Brazil and the BRIC economies is that they've started to put their infrastructure in place around 2002 onwards, and therefore it's always been internet-based. And so when we look at the best examples of innovation around the world, we talk about those economies along with Poland and Turkey and some others, because they have been doing things afresh and new with no legacy, no heritage. Then the third stream economy is Africa, Philippines, Indonesia, Colombia, and some others where they started with nothing and are just reimagining everything because they had nothing before. I was just recently in Rwanda, and I didn't realize till I went there that Rwanda is the safest country in Africa, which is good, but also one of the most friendliest countries I've been to in Africa, that has an ATM every 5 meters. It's a human being. And the human being is there engaged to pay money in or pay money out on the mobile networks, MTN, Tigo, Airtel. And it's just rethinking things into different spaces. And eventually, I think we'll end up in one global universal marketplace. I'm working on some new ideas at the moment where it's too long to talk about, but as we become space travelers, which we will, ask Elon Musk, what happens to money? Never see Captain Kirk pay for anything. So we end up with this universal network system of debits and credits that's taking place through devices. That's what the Internet of Value and the Internet of Things is creating. And that universal global network includes everybody, which is the reason why the 4.2 billion people who are excluded from banks and financial services until the last 5 years are now included because they have a mobile network. And within 10, 20, 30 years, they will all be exactly as capable as we are of transacting and trading and talking and being entrepreneurs. That will change the world.
Great. With that, thank you.
Thank you, Rob.